All right, welcome back. Now we're going to apply those present value concepts to accounting for long-term liabilities. So it says on January 1, Starbucks bought new delivery trucks and they signed a note agreeing to pay $200,000 on December 31, 2020. So that's 2 years later. The note's non-interest bearing because no interest payments are required. The interest is built into the final payment. The amount that the market interest rate would be 12%. And the first thing we need to do is figure out, well, what is the present value of these delivery trucks today? So we basically have to take out the interest. The answer at the bottom here is shown using the tables. We're going to use our calculator. So N is going to be 2 because there's 2 interest periods. I is the 12%. PV is what we're looking for. Payment, there are no payments each period, so that's 0. Future value is the one payment we make at the end, which is $200,000. So you can make that negative if you want because it's an outflow of cash. We pop that in our calculator. We should arrive at the same answer that the textbook got with the charts. So let's try it out. Down clear. 2 is N. I is 12. PV I'm solving for, 0 for payment, 200,000, negative for my final amount at the end. So what is the value I'm getting today? 159,438. So we're off $1 because of rounding, but close enough. And it shows up positive because I'm getting equipment in today as an inflow, and I'm going to pay out the 200,000 at the end. What's the difference between the 159 and the 200,000? Well, that difference represents interest that's imputed in this situation. So how would I go about recording this? Well, upon the purchase of the delivery trucks, I'm going to record those for their present value. So in our accounting equation, what happens is I'm exchanging a liability of 159,438, that's the present value, for an asset valued at 159,458. And I have dyslexia, 438. So the delivery trucks are going to go up with a debit for that amount, and then my liability goes up by that amount with a credit. Then what happens is over the first year, interest is used, so we have to calculate the implied interest. So to do that, we take our loan amount, which is initially the 159,438 times the interest rate to figure out what our implied interest would be. So once we figure out that the interest in the first period is 19,133, we then record an entry to record the interest. And because we're not paying it, it's going to be added to the amount of the loan. We add it to our note payable. So in our accounting equation, our expense goes up by 19,133, which makes net income go down and equity go down. And then our liabilities go up by that amount because we haven't paid it yet. Then in the next year, we have to figure out our new interest. So now we have a loan of 159,438 plus the 19,133 that we had in interest and that was unpaid after the first year, which means our loan balance now is 178,571. And we multiply that by the annual interest rate. And though it's not shown, we're really multiplying by the number of months outstanding over 12 in both of these problems. But because it's a full year, it's 12 over 12, which is 1, so that's why it's not being shown. And that gets us the interest for the second period, which again increases our expense, 21,429, which makes net income go down, which in turn makes our equity go down. And then our liability goes up by that same amount because we haven't paid it yet. That brings up our liability to the full amount that we owe at the end, which is $200,000. So if you take your initial loan plus the interest for the first 2 periods, you end up at the $200,000 you owe at the end. So at the end of the 2 years, we're going to pay off that entire amount that we owe, which is now the $200,000. So our liability is going to go down by the $200,000, and our cash is going to go down by the $200,000. And to make that happen in a journal entry, we debit the liability and we credit the cash. So our liability at the end is $200,000 because we started at the $159,438 and then we added interest for the 2 years, which brought us up to that $200,000 that we owed. So basically, the way this loan was structured is that we paid all of the principal and interest at the end. Let's look at another example with an annuity. Starbucks purchased equipment with a note payable to be paid off in 3 years. At the end of each year, they're going to pay $163,685. Each payment includes principal plus interest, and the annual interest rate is 11%. What's the present value of this annuity? Well, using our calculator, N is going to be 3 because there's 3 years. I is going to be the 11%. PV is what we're looking for. Our PMT is the payment each period, which is $163,685. I'm going to make it negative because it's a cash outflow. And then FV is 0 because at the end you owe nothing. So if we pop that into our calculator, 3 is N, 11 is I, 163,685, negative for PMT, 0 for our future value. Our present value is $399,999. So the answer is A. This is showing you the answer using the present value of an annuity factor from the charts. We don't use the charts. We're going to use our HP10B. So the answer is $399,999. That's the present value of the note, and the company makes those payments. So in other words, if we had deposited $399,999 at 11% interest, that would allow us to pay the $163,685 for 3 years. So the $163,685 times 3 is $491,055. So why is there a difference? Why are we paying more than the $399,999? Because of that 11% interest. So how do we do our journal entries? Well, when we purchase the espresso machines, we're going to record it at the present value, which is the $399,999, which makes our assets and liabilities go up. And then we have to record interest each period. So after the first year, the interest is the principal times the interest rate times the number of months outstanding over 12. Because it's a full year, it's 12 over 12. That gives us interest of 44. Well, our journal entry is going to record the interest of 44 and the cash payment of $163,685. We know both of those numbers. The note payable amount is a plug. So that's the amount of the payment that is left to go towards the principal amount. So that's a plug in our entry. So we know our fixed payment is $163,685. We calculated our interest as 44, so the difference is going to be a plug to notes payable, which reduces our liability. So now the remaining payable balance is $283,14, which is the $399,999 minus the $119,685 from the entry. And then we would figure out our interest in the second year by taking that $283,14 times the 11% times 12 out of 12. That gives us interest of $380,835. So again, we know the $163,685 payment is a credit to cash. We know our interest we just calculated is $30,835, and then the amount that goes against the loan would be a plug. That then reduces the loan balance. So we go from $280,314 down by the $132,850. Gives us a new loan balance of $147,000. 464 times the 11% interest times 12 over 12 gives us interest in the final period of 16,221. Do out our entry. We know our payment is 163,685. Our interest we calculated is 16,221. So the plug is the amount that goes against the loan, which you'll notice is 147,464, the same as the remaining balance. So after we make that final payment, after year 3 is over, we now owe 0 on the overall loan. That's the idea behind it. So we make 3 payments in the amount of 163,685. Each one is partially for interest, partially for principal. And when we're all done making the 3 payments, we now owe 0 in our loan. What happens when we have a loan that involves payments each period and then an additional amount at the end? So here Starbucks bought new coffee roasting equipment and agreed to pay a supplier $1,000 a month for 20 months and an additional $40 at the end. Well, if we're using the charts, it's a big pain in the ass and there's multiple steps. So luckily we don't use the charts, though I left the steps in here for you. The way we would do this is we would use our calculator. N would be 20 months. It's already in months. It's been converted. I is going to be the 12% interest, but we have to divide that by 12 to make it monthly, which is 1 per month. PV is what we want to know. What is it worth today? PMT is going to be the payment of $1,000 each period. I'm making it negative because it's an outflow. And then FV now is an additional $40,000 payment at the end, which I'm also making negative because it's an outflow. So all I need to do is plug that into my calculator and I'll have myself an answer. So we clear it up. 20 is N, 1 is I, 1,000 negative is my payment, 40,000 negative is the lump sum I pay at the end, the future value, which means the present value is 50,827, showing as a positive because that's an inflow, the value I get when I receive the coffee roasting equipment. If we were to use the charts, it would take 3 steps. We'd have to figure out the present value of the annuity payments and the present value of the lump sum at the end, and then add it together, and we arrive at the same answer within $1 because of rounding. Obviously, not dealing with charts and having to figure out which factor to use makes this a lot easier. So using our calculator, we could focus on the top row in our calculator and answer any time value money question without worrying about charts and which one to use and do I multiply, do I divide, what do I do? It's very, very, very easy to use the calculator once you get used to it and you learn how to define the variables properly. Just remember with your N and your I, you have to convert that to make sure it's per the periods involved. So if it's monthly, we got to take the years times 12 and the interest rate divided by 12. If it's quarterly, we take the years times 4, the interest rate divided by 4, and so on. In Supplement A in the textbook, you can find more information on how to use the HP 10B 2+. So you can look into that if you need additional instructions. I'm sure you could Google how to use it and find some YouTube videos. And if you bought an HP 10B new, it came with an instruction book. You can always read that. But in any case, the supplement provides some additional information on how to use the HP 10B, gives you the steps involved, which I've already went through as part of our lecture. It also tells you how you can use Excel to calculate present value. So if you're interested in that, you can read through the supplement on how to do that as well. Again, we focus on the HP 10B. It's required for the course, so that's why we only show you how to use that calculator. And that is the end of the lectures for Chapter 9. But it isn't the end of using our HP 10B. We're going to go through various time value money calculations in our next chapter that deals with bonds. As always, please utilize the resources available on Connect and Canvas to better understand this material. Practice makes perfect, and there's a lot of practice resources. You can also reach out for help through the discussion boards as well as via email if you'd like to set up a Zoom office hours appointment.